those closest to the money, those who get it first benefit the most. And so the finance industry, government spending. So when you get the money early, eventually that increased money supply is going to increase prices. But if you're one of the first ones to receive the money, you are able to go out and spend that money before it loses its value, before prices in the economy have adjusted. So let me give an example. So yeah, so when the central bank does quantitative easing, for instance, they're monetizing the debt. That's what they're doing. They say they're not because they do it indirectly. They use the banks as conduits, and they buy most of the, at least as of 2013, most of the assets that the Fed was buying through quantitative easing were from hedge funds, or families, as they like to call them. There's a piece by Seth Carpenter, who worked at the Fed in 2013, which people can look up, and I cite it in my book. And so the hedge funds will sell the bonds to the bank and the primary dealers, and then they sell that to the Fed. And so then the government issues all this debt, all this primary issuance, which the Fed is not allowed to buy. But as soon as the hedge funds get it, they just sell it to the primary dealers, who sell it back to the Fed. So they are monetizing the debt. So now the government has all this extra money that it can go out and spend or send checks out to people. And those receiving the checks first, or however they're receiving the money, can buy stuff before the prices go up. If you're the last to receive the money, by the time you get it, the money has been devalued and prices have risen.